Fellow investors, it's Raymond here with another video, and this is going to be our third, I believe, video in the series of German materials stock reviews, financial statement reviews. And in these financial statement analysis videos, what we do is we look at the three main financial statements, that being the balance sheet, the income statement, and the cash flow statement. And we look at the key features of each statement, and we attempt to determine the financial strength of the company at the present time, as well as the future viability of the company. Without further ado, let's get into the key ratios. So as you can see, I've invested £1, which I'm not too sure about the date I invested this pound, but I received a negative 41% return. You have to consider that the market is very volatile at the moment, and a lot of the value of the stock of the stock market has been wiped out. The economy is slowly recovering, but it's not definite as to it's a certain recovery or if it's just market volatility and people speculating, because a lot of the stocks haven't actually changed much in price, but some of the stocks have gone up. So we don't really know if the economy is recovering or if it's just general speculation. So the key ratios, the first one is the market cap, which is very important. The market cap of, sorry, I didn't actually mention the name of the company. The name of this company is called Covestro. The market cap is 6.56 billion euros. PE ratio, which is a price to earnings ratio, which determines the expensiveness of the company, if you will. The price per share divided by the earnings, the price divided by the earnings per share, which is kind of like as I said, a level of it determines the expensiveness of the company. So the PE ratio is 4.06, which is really good. Usually a really good level would be about 10, but we rarely find that. But as I said earlier, we are in quite a dire economic situation where all the prices of most stocks have gone down quite substantially. So the revenue figure is 15.9 billion. That is for 2021 financial. All of these key ratios are for the 2021 financial year. Well, I guess some of them have been updated as the time has gone on. So the revenue figure is 15.9 billion, which is almost 3 times the size of the market cap. So we're going to look at which is actually quite frequent. We've seen that trend quite frequently in our financial statement analysis videos. So we're going to look at the performance over the year. So it's gone down. The stock has gone down by 39%, almost 40%. Does that justify a 300% gap? Sorry, a 200% gap? No, but I guess it justifies some of it. The dividend yield is 10, which is actually quite good. We're going to look at the earnings per share, which is similar to the price to earnings ratio, but it's kind of like half the price to earnings ratio. The price to earnings ratio is the share price divided by the earnings per share. But the earnings per share is just, I guess you can tell by the title, is the earnings, the earnings, which is the net income for the year, divided by the amount of shares that's outstanding. So that is 8.37 euros. Let's check the market price. So that is really good, actually. That's almost 33%, which is really good. So we're going to look at the first of the... Oh, sorry, I forgot about the beta. The beta is the risk level of the company in a number. So the beta for this company is 1.23, which is about 23% above the market average of 1. Sorry for the background noise, by the way. There's a lot of construction. I want to close the windows now just so I can reduce the background noise. 1 second. Hopefully that solved it. You might still hear a bit of background noise, but that's the best I can do. So the income statement is the first of the statements we're going to look at. So as you can see, there's a progressive increase in... Well, I wouldn't say progressive, actually, because the 2019 financial year had a higher net income figure than the 2020 financial year, but relative to the revenue figure, the net income is higher. So I would say a progressive increase relative to the revenue of the net income is present So the from 2019 to 2021, the revenue figure, of course, isn't consistent. It's quite inconsistent. But the profit margin of the last financial year, 2021, is actually quite good. You can tell it's about 13%, which is good. Anything above 10% is good. So we're going to look at the balance sheet. The balance sheet shows the balance of liabilities to assets. So the assets are what the company owns, and the liabilities are what the company controls, but it's borrowed. It doesn't belong to them. And also, liabilities almost always come with interest. So they have to pay back the principal, which is what they borrowed, as well as interest to whoever they borrowed the assets from. So that needs to be factored in for when considering the net income. So if the net income is very low, and the debt to asset ratio is above 50%, then that wouldn't necessarily, the company wouldn't necessarily be so attractive, because the company has to pay a lot of interest. So that has to come from net income. Of course, they can defer the interest and stuff, but in most cases they can't, because it's usually an incremental payment of interest. And also they eventually have to pay back the principal. So let's check the cash flow statement to see how they manage their debt, as well as how they manage their cash. The net income is the starting line, 1.62 billion euros, which is really good actually. And the cash flow statement is divided up into three parts, which the first is the cash from operating activities, the next is the cash from investing activities, and the last is the cash from financing activities. Then at the end you get the net change in cash, which we can see here, which is 755 million. So definitely, as we go through, we can definitely tell that by the net change in cash that the company spent a lot of its cash. Has to be way over 2 billion euros. Let's see whether or not they spent it on anything adequate, and if they're likely to get a good return on investment. Of course, we might not be so accurate in judging, but we can just make a guesstimate. 2020 financial year, the net income starting line was 454 million, and the company gained 200 million. And 2019 financial year, the net income starting line was 557 million, and the company spent about 600 million, just over 600 million. So 2 out of 3 years, the company's been at a negative net change in cash. That's not necessarily a bad thing. It just means that the company has spent more money than its net income. Usually that's not great, because the company's spending a lot of cash, and the net change in cash is quite weak, especially negative. The shareholders that are, potential shareholders, as well as the present shareholders, are going to be repelled. It's not necessarily a positive figure, but then again, you never know what the company's investing in. But if they're always having a negative net change in cash, it's not necessarily always a good thing. But we're going to check the cash flow statement to see what the company spent the money on. So the operating activities, the company gained 2.19 billion, which is really good. The company also gained 2 billion from the company lost 2 billion in investment activities. It spent 764 million on capital expenditures. So I'm guessing property, plant, and equipment. It probably brought more physical capital to increase productivity. And other investing cash flows items, it spent 1.23 billion euros. So that's about 2 billion euros right there. And the cash from financing activities, the company lost 965 million euros. Let's see what it's spending money on. A lot of it was spent on dividends, so dividends were given out, and the retirement of debt. So it got rid of some of its debt, which is really good. So before this, it had more debt, which is good. They got rid of a lot of debt, so a lot of interest along with that is gone. So hopefully they can do that along the preceding years, and reduce their liabilities, so the company will be more attractive to investors. And the net change in cash, as you saw earlier, is 755 million negative. Not necessarily a bad thing, but hopefully in the future they do manage to get it to a positive figure, but it has to be justifiable. If they ended up at a negative figure but gaining a lot of cash, or managing to have a positive net change, or if they're managing to gain a lot of cash from operating activities, and they end up with a negative net change in cash, and also they have a high net income figure, it could be justifiable if they're getting rid of doing things like getting rid of a lot of debt, paying out dividends, which is debatable actually, paying out dividends to shareholders. That could be very attractive to shareholders. But yeah, apart from that, thank you guys for spending time to watch this video, and I will see you in the next one.